Okay, everybody, this is Carlo, better known in the space as the DeFi Defense Lawyer, and I am coming at you live in a multicast. We're going live on X via live stream, and we're going live on TikTok via live stream. I have never done this before, but we're going to give this a shot. So what am I doing today? Today, I want to start the journey in educating the community as to what stablecoins are, especially stablecoins under the Genius Act, which is a fully regulated stablecoin regime. This just was passed and signed into law on Friday of last week by President Trump. This is a major breakthrough for the crypto sector, for the banking sector, and I want to bring you as much information as I can to empower you as listeners to help you understand how to better utilize this new and revolutionary way of moving money around the world to improve your bottom line, to increase the speed of moving money, and to break the hold that banks have on moving money at the speed of banks. Now, first, by way of introduction, for those of you who don't know me, I'm Carlo D'Angelo. I'm an attorney. I'm based in Texas, and I have been practicing criminal law for probably well over 25 years. In addition to practicing criminal law, I also advise crypto startups. I have spent a great deal of time learning and understanding this technology over the years, and I have taken the valuable insights and experience that I learned from defending federal criminal cases involving crypto fraud, involving the use of money transmitter statute and the FinCEN crimes involving digital assets that are regulated and are policed by the DOJ, by the Treasury. And I've taken all that experience that I've gained in defending those criminal cases, and I've applied that to advising startups in the crypto sector on how to navigate the crypto sector in a legal and regulatory compliant way. So before I was a fully practicing lawyer, I was a public defender. And for a short time, I was also a professor of law. As an assistant professor of law, I got to do what I love most, which is teach, which is why I'm here on a Saturday offering this content. This is, by way of disclaimer, strictly for educational purposes. Nothing we talk about here in this live stream should be considered legal advice or the formation of an attorney-client relationship. This is strictly for informational and educational purposes. If you have specific legal questions about stablecoins, you should consult a lawyer, and you should do that privately, not via a two-way chat on a live stream, because we are not doing legal advice here. We're strictly educating. So what are we educating the community about here? I promise in the upcoming series, I will improve this pitch. This is my first time doing a live stream like this, but we're just going to go for it. I love teaching and I love providing education, and I've been covering the crypto sector for a long time. For those of you who are familiar with me, I have a newsletter that I put out where I've covered virtually every major legal development in the digital asset sector. That newsletter is available on Substack. Not going to bore you with all the handles because those are all in my bio under my link tree. My website's there. If you want to learn more about me, my newsletter is there. My X and TikTok handles are there. Also, I host a podcast called LexLine, where I've interviewed some of the best artists, builders, and creators in the digital asset and crypto sector and gotten to unpack their process and their journey. I think we're closing in on almost 200 episodes of LexLine, and that's available on Spotify and on Apple iTunes podcasts if you want to check out my prior interviews. And I guess that's about it for bio. So let's jump into what we're talking about here today. And yes, I have notes because there's no way I can remember all this. I have been covering the Genius Act since it was first proposed in Congress. And I firmly believed when this act was introduced that this was going to completely turn the way we've moved money around the world on its head. Now, for the crypto natives who are catching this on X or on TikTok, and you follow my contact, and you already know crypto, you already know blockchain, you already understand digital assets, you're thinking to yourself, why am I watching this on a Saturday? What difference do stablecoins make for me? Well, I think if you zoom out a little bit, and I'm going to give you my thesis on this. I think that stablecoins under the Genius Act are going to be the Trojan horse that is going to onboard millions of non-crypto native consumers to blockchain technology. The reason I firmly believe that is because the biggest friction point we've had to bringing people into digital assets is that they're not comfortable working with this technology. They're not comfortable with all the news they read about how volatile these assets are, and they're just frankly afraid to play with this tech. Now, what stablecoins offer is they offer all these non-crypto natives an opportunity to dip their toe into the pool of digital assets through fully regulated stablecoins. So as part of what I'm going to do today in this education series is I'm going to kind of explain what stablecoins are and how they differ from traditional cryptocurrency digital assets. The number one thing that you need to understand about why stablecoins are different, especially stablecoins under the new Genius Act, is because stablecoins they differ from traditional cryptocurrencies like Bitcoin, Solana, Ethereum, XRP, and all the other cryptos that you're familiar with and heard about in the news, because those cryptocurrencies are speculative assets. They go up and down depending upon the demand and the interest in those assets. So they come with a degree of risk because depending upon what the consumer sentiment is and what the market conditions are, they can go up or down dramatically. And we've seen those dramatic price moves up and down. We've seen incredible up movement in Bitcoin recently, and we're all excited about going into the bull run. But we also know if we've been in crypto long enough that what goes up comes down, and there's a lot of volatility. So stablecoins are different than those other cryptocurrencies because stablecoins offer users a one-to-one pegged asset, and it's pegged to a US dollar-backed asset under the Genius Act. So what that means is they are not for investment purposes. They are for transacting, for moving money around. That is the key difference. You use stablecoins to come in and out of your cryptocurrency investments when you want to take your profits. You can park them in stablecoins, and that is backed by an underlying asset. Now, right now, we have two predominant stablecoins that are available to consumers. I think the two leaders, and everyone would probably agree with me on this, are USDC, which is put out by Circle, and Tether. And Tether is USDT. Now, these two are the front runners and right now the most stable stablecoins that are out there because they are predominantly asset-backed by US Treasury equivalents. Now, the problem that we had prior to the Genius Act is that there were no clear legal or regulatory standards as far as what these assets needed to be pegged to or backed up to. Think of stablecoins like this. Once a stablecoin is created by either Circle or Tether, in order for it to have a stable value to the US dollar, it has to be backed by an underlying asset. Circle backs their stablecoin by US dollar treasury equivalents. And Tether, although it is an offshore entity, also has a backing under the underlying US Treasury assets. But in order to really mainline stablecoins into the consumer world, we need to have some government oversight and we need to have assurances that they are fully audited and that they are indeed backed one-to-one by Treasury equivalent assets. That's why the Genius Act is such a game changer for all this, because now it creates that regulatory oversight that's going to give consumers, that's going to give banks, that's going to give businesses, and anyone else who wants to launch in the fintech sector a stablecoin comfort to know that they'll be fully audited and they won't depeg. Depegging of stablecoins is a problem because if you are exchanging stablecoins under the assumption that they're going to be backed one-to-one by a dollar equivalent asset, I should say, if it loses that peg, if it loses that connection to the dollar, well, then it introduces volatility and uncertainty. And we've seen that happen a few times with Circle and USDT, where it has temporarily depegged. We saw the nightmare, if you have been in crypto long enough, of the Terra Luna disaster. Terra Luna was a stablecoin, which was an algorithmic stablecoin, which means it wasn't backed like USDC and USDT. And when it depegged, it was a huge contagion effect that affected the entire crypto market when it lost its peg. So while stablecoins prior to the Genius Act maintained good relative stability and peg to the dollar, there was no strict auditing process in place to make sure that every one of these stablecoins created is indeed backed one-to-one by a US Treasury equivalent. So in the United States going forward, if you want to launch a compliant stablecoin under the Genius Act, you're going to have to follow several strict guidelines to make sure that your stablecoin is backed, will not depeg, and that people who hold that stablecoin are protected. Now, before we jump into the nuts and bolts of what the Genius Act is and what it means for stablecoins, let's talk about the use cases for this. Why is this important for people? It's important for people because currently, when it comes to moving our money around, we rely predominantly on banks. Banks extract fees to provide that service. Banks are supposed to hold your money and have it available to you whenever you need it. But banks operate under a fractional reserve model, which means that banks are allowed to lend out your money and earn interest on that, interest that is much higher than what they pay you on your deposits. And that's how banks make money. They make money by taking your money under the fractional reserve model and lending it out to other people and earning interest. And that's why you've got to have FDIC insurance on your bank deposits, because if there's a run on the bank, if everybody wants their money all at once, it's not there because it's fractionally reserved. So the FDIC has to step in sometimes and bail out banks and consumers when the banks have no way to fulfill the demand for deposits. Now, the other way banks make money is fees. Banks charge fees to move your money around. They charge fees for wire transactions. They charge fees for checks. They charge fees for credit card vendor transactions. And all these fees add up and eat into your bottom line. Stablecoins free consumers from this fee monopoly because stablecoins can be moved on a blockchain instantly at the speed of the internet, not at the speed of banks, as I like to say, 24/7, 7 days a week, 365 days a year. It took me a while to think about that. And without the delays and the fees that come with traditional banking rails. You see, part of the friction in moving money under this antiquated bank system that we currently have is, number one, banks charge fees to do this. You get wire fees for sending wires. I've gotten wire fees for receiving wires from customers who want to hire me. You have delays. You don't know when your wire has actually been sent. You don't know when it's been received by the other party. You have to constantly rely on the bank and check with the bank. Did my wire clear? Did my funds clear? Constantly go online and look and see if the wire arrived, if the wire left. And the problem is, if you want to send a wire on the weekend, you don't have that luxury because the banks are closed. So you are stuck having to bank at the speed of banks and at the convenience of banks with exorbitant fees. Stablecoins solve all of this. Stablecoins solve all of this under the Genius Act by giving consumers an alternative where they can move money at the speed of the internet, not at the speed of banks. They can move it 24/7, 365 days a year without having to rely on banking hours. This liberates consumers from having to rely on even Zelle and Venmo and all this stuff. This is all just another variant of the bank fee extraction, slow-moving technology. Stablecoins break all of this, and they do it instantly so that when you hit send, you know your stablecoin has left your account, and you know it's instantly appeared in the wallet that you're sending it to because you can see it on the blockchain. So what does this mean for consumers? Well, they can move money around instantly without having to rely on the intermediary that is banks. That's amazing. They can do it 24/7, 365 days, so they don't have to rely on banking hours. What does this do for businesses? I'm in a business. I receive credit cards from customers. I have to pay merchant fees every time a customer pays me with a credit card, sometimes 3%, it depends, but that's a huge extraction of money from my bottom line. If consumers were able to pay me with stable coins, we bypass all of that. The money leaves their wallet instantly and ends up in my wallet, and the payment is processed, and I don't have to pay an intermediary for the pleasure of moving money around. That's a big game changer. Also, if you're in a business and you're dealing with vendors or suppliers or customers, you can totally revamp your payment system. So now you can receive and send stable coins to pay on invoices, to pay vendors, to get paid for your goods and services, and it can all be done instantly, and it bypasses the bank monopoly. The other benefit is if you're dealing globally with stablecoins, you now, under traditional business model, if you have a business where you're receiving money from overseas customers or you're paying for things overseas, you have to depend on the banks to send it through the SWIFT's wire network, which comes with fees and delays, just like we talked about. You have to deal with currency volatility, the conversion rate between the currency you're sending and the currency it's going to be converted to. And this creates a lot of friction. If the world adopts stablecoins, and if the world has stablecoin equivalents that comply with the Genius Act, then you eliminate all this because now they're pegged one-to-one. They move instantly on a blockchain, and this gives businesses the power to break that fee monopoly that banks have over moving money around the world. Another sector that will benefit tremendously, I predict, from stablecoins are family offices. Family offices are groups of high net worth people who get together and try to pool their investments, to manage their investments, and to find good investment opportunities here in the US and all over the world. Well, traditionally, when they have an opportunity to invest money, they have to rely on banks and wires and all the things we just talked about to get into those investments. Well, sometimes the timing isn't great because if you've got a great opportunity and it's a weekend and you can't get that money over there to get in the deal, sometimes you lose an opportunity to capitalize on the deal. You also have the fees that come with it, which eat into the bottom line. You have the uncertainty of when the money's going to get there. If you're dealing with an overseas deal, you have an interesting opportunity in Dubai that you want to move on. This is an investment you want to make. However, it's Friday afternoon. You can't get the wire out. You got to deal with the currency conversion from the dollar to the dirham. You got to deal with all this uncertainty. Why not just use stablecoins under the Genius Act to get into that deal immediately? You could do it on a Sunday. If the right deal comes along and the right opportunity, you've got now power. So this is empowering consumers, businesses, and family offices to move money around. We're going to see a tremendous influx of stablecoins being introduced. And I'm going to talk about what's required in order to launch a compliant stablecoin. And we'll talk about how this is going to impact the existing bank sector. You see, I've talked with some people in the banking sector, and I can tell you firsthand that they are largely oblivious to what's happening here. If you are in the banking sector and you don't know what a stablecoin is, and you don't know what the Genius Act is, I can tell you with great certainty that you are in store for quite a surprise, because this is going to be the single greatest disruptor to your sector that you have seen in decades. And I can tell you that many banks, especially the smaller regional banks, community banks, they're completely asleep to what's happening here. And if they don't quickly educate themselves and retool their processes to be able to receive these and process these stablecoin transactions for consumers, well, they're going to lose customers because they're going to have a hard time explaining to customers, hey, I could have put you in stablecoins to move money around, but instead I left you in wires and credit card fees and checks. So now you have to worry about checks bouncing, checks getting reversed, checks clearing. I mean, it's crazy that we still use checks, truthfully, to move money around, but we do. And we know the experience with checks bouncing, reversing, and so forth. So when you're sitting across the table with your banker and you're like, hey, what are these stablecoin things? And why didn't you turn me on to this? Why didn't you give me this opportunity to save on my bottom line and to move money more efficiently? Banks are going to have a hard time explaining why they didn't do that. And some banks are just going to be completely asleep to this. So they're going to lose customers, which means they're going to lose the ability to lend out the customer deposits on their fractional reserve model to make money. And they're going to miss out on the ability to extract fees from those customers by doing things the old-fashioned way. So some major banks are waking up to this. JP Morgan and other major banks are talking seriously about stablecoins and integrating stablecoins. But something you need to be careful of as a consumer, and that's why I'm here to educate you. Remember, this is not legal advice. We're not forming a legal an attorney-client relationship here, strictly providing this to you for educational purposes. But you got to carefully look at what these banks are offering, because some of these banks are going to try to morph their traditional banking services and call it a stablecoin offering. They're going to spin up their own compliant stablecoin, but it's not going to be a true stablecoin, and it's going to have additional fees that aren't necessary. And they're going to try to pass this off on you when, frankly, they're not giving you anything of value for these, because you can move stablecoins on your own with your own wallet. And if they're fully pegged, regulated under the Genius Act, you don't need extra fee extraction from banks. So this is a real threat to the current banking system. And banks that adapt are going to probably make money on this and retain customers and grow their deposits. Banks that are slow to adapt to this are going to lose customers. And the fintech providers who are tech forward, who understand blockchain technology, like let's, for example, say Coinbase. Coinbase is rapidly becoming a bank. They just partnered with a major US bank, and I fully predict that they're going to be integrating stable coins into their new banking offerings. So you're going to have very savvy, tech-forward fintech companies that are now going to be competing directly with banks for customer business when it comes to moving money around. The reason that I am doing this on a Saturday is because this is all well and good, but the vast majority of consumers still have no idea what stablecoins are and how those stablecoins under the Genius Act can benefit their bottom line. Businesses are largely asleep to this. Family offices largely have no idea what's going on here, and consumers have no idea. So in order for consumers to benefit from this, from businesses to benefit from this, and from family offices to benefit, and even banks to benefit, it's going to take an education campaign. I firmly believe, like I said earlier, that stablecoins will be the Trojan horse that onboards millions of new users to crypto, because once they discover the power and the freedom and the liberation that comes with these fully regulated stablecoins, where they're going to quickly understand that blockchain technology is far superior for moving money around. And once they open a wallet, a digital wallet, where they can store cryptocurrency, and once they start receiving these stable coins into the wallet and sending them, and they get comfortable with the tech, they're inevitably going to bridge into other crypto assets. They're going to see how easy it is within their digital wallet to take their existing USDC, for example, and buy Solana, or buy XRP, or buy Ethereum. And that's going to give them exposure to the other side of blockchain cryptocurrency technology, not the transactional stablecoins, but the cryptocurrencies that we are all familiar with that are for purposes of growing your net worth, investing, and let's face it, having a hedge against dollar volatility. Now, one thing I haven't talked about, and I want to get into this before I jump into the nuts and bolts of the Genius Act, is what does this mean for America? There's been a lot of controversy around this bill. Some people were afraid that this is a backdoor to a CBDC, a centralized bank digital currency. And I want to address that. Also, if you're leaving comments, I love it. You don't have to agree with what I'm saying. And in fact, I could be wrong about what I'm saying. I have an open mind. So I'm happy to hear your comments. Leave your comments. I want to have an open debate about this stuff, and I want to not only educate you, but I also want to inform myself. So if you have a different take on this, leave a comment. I'm happy to read them. But what I want to stress here is that this is not a CBDC. For those who don't know what that is, a central bank digital currency is spun up by the government, issued by the government, and controlled by the government. The EU is going in that direction. They want an EU CBDC. We have a piece of legislation that has been proposed in the House, which hopefully will go through the Congress and will become law, which will ban the creation of a CBDC in the United States. This is very important to the future of the freedom to transact digital assets and to the future of DeFi, which is decentralized finance. The reason this is very important is because if the government can issue these digital dollars, then they can turn them on and off. They can control how people get, send, receive that money, and that's a dangerous threat to freedom. Right now we have cash and people transacting cash. Digital dollars could replace cash, and if digital dollars are controlled by the government and they have the power to turn it on and off, you can understand why people would be very, very concerned about that and see that as a direct threat. So, stablecoins under the Genius Act are not that, because they are not created by the government. It is simply a law that enables qualified banks and other fintech providers to privately launch stablecoins. These stablecoins are not turned on and off by the government. Now, of course, they fall under government regulation, which means they have to comply with know your customer, anti-money laundering laws, stuff that I have been deep in the woods on as far as criminal defense and defending criminal cases of money laundering and digital asset fraud. I'm very familiar with all of this, and I know that there was no way this law was going to pass unless those measures were in place. So this isn't a green light to just simply move money around without anyone knowing where the money is coming from, who the money is going to. This regulation that's going to unfold as the Genius Act starts to become implemented is going to have very strict controls on all this, just like the movement of cash and just like the movement of fiat currency under the current banking regulations. This is just an extension of it. So I wanted to alleviate that concern that somehow stablecoins are turning into digital dollars that are government controlled. No, they're government regulated, okay? So now that we've talked about why digital assets like stablecoins under the Genius Act are not a CBDC, why are they good for America? Here's my thesis. And again, leave comments if you disagree. I love comments. I want to see comments. Give a follow too if you want more of this. Remember, I'm providing this for educational purposes because I want to educate consumers about what's coming so they can prepare. Because now that it's law, the next step is it's got to be implemented through the regulatory process. We probably have a maybe 6 month to a year window before we really start to see stablecoins under the Genius Act start to get spun up and start to get offered, okay? So now's the time to get educated if you're in a business, if you're a family office, if you're a consumer, and if you're a bank. Again, banks, pay attention. I'm trying to give you alpha here to make you understand your way of doing things is coming to an end, and if you don't adapt, you're going to lose consumers. So why do I think it's good for America? I think it's good for America because if it is required under the Genius Act that every stablecoin that's created has to be backed one-to-one by a dollar equivalent treasury asset, well, that is going to boost demand for U.S. treasuries. You see, our dollar is the dominant currency in the world because of our status as a superpower, of course, our military might, of course, and the fact that the world is comfortable sending and receiving dollars because they believe it's backed by U.S. treasuries and it's a stable asset. If you are increasing the demand for treasuries around the world, and if stablecoin issuers must continue to buy U.S. equivalent dollar treasuries in order to back every stablecoin generated, well, you're going to solve a big problem for the current Treasury Secretary, Scott Bessent, whose job it is to go around the world and sell treasuries. When he sells treasuries around the world and when he increases demand for treasuries, that opens up dollar dominance because it makes the dollar even stronger. He's predicted, and I've seen many predict, that this is going to be maybe $2 to $3 trillion boost to the treasury market. Now, how do these stablecoin issuers make money off of this? Well, treasuries pay yield. So for every treasury that they buy, their fee model is that they earn interest on those treasuries. They don't earn money on the stablecoins themselves. They earn money on the backing of the stablecoins with the treasuries. So this is a flywheel, which I think, if executed properly, is going to increase demand for treasuries and increase dollar dominance and dollar stability. And that is all good for America, in my opinion. Again, if you disagree, I want to see your take. I'm always open-minded to learn more from you to help me better understand and to help me better teach this stuff to people. So any comments you leave are welcome. Definitely give a follow and a share if this is bringing value for you or anybody else that you think might benefit from learning this stuff. So now let's break it down. Okay, the Genius Act, guiding and establishing national innovation for U.S. stablecoins. That's what it stands for. It's genius. It's the first comprehensive U.S. federal law to regulate the payment mechanism known as stablecoins. It creates a federal, state, supervisory regime because under the Genius Act, you can launch stablecoins under a state regime or a federal regime. It provides licensing, reserves, redemption, auditing, anti-money laundering, which we'll just call AML for purposes going forward, consumer protection, and protections against insolvency. Now, who can issue stablecoins? For those who are in the fintech sector and want to consider issuing a stablecoin, there's a limited charter for issuers. It's unlawful for any person to issue a payment stablecoin in the US unless they are, quote, a permitted payment stablecoin issuer. That includes insured depository institutions and subsidiaries, basically banks, federal qualified non-bank issuers, a non-bank entity chartered or licensed at the federal level by the OCC, the Office of Comptroller of Currency. So if you're not an existing bank, you'd have to get that qualified non-bank status to do this. And state qualified issuers, same deal. So it limits who can spin up these stable coins. And that's kind of important because one of the big points of contention in all this is the people that have been launching the war on crypto, Elizabeth Warren, Maxine Waters, and all these other people that are anti-crypto have been screaming that this is going to empower tech companies like Facebook to launch stable coins and it's going to destroy the dollar and destroy the economy. Well, there are specific restrictions. There is a special restriction against big tech companies. The act contains a unique restriction to prevent large non-financial tech firms from issuing stable coins without heightened scrutiny. A public company not predominantly engaged in financial activities, meaning not a major e-commerce or bank, may not issue a payment stablecoin unless they obtain unanimous approval by a stable certification review committee, which means they're going to have to get approval to do this. And we've heard that Amazon wants to jump into the stablecoin game, and I can see why. Think about the number of goods and services that move through Amazon. You can quickly understand why stable coins are going to enter a super cycle in the United States, and we're going to see more and more stable coins coming online and being sponsored and being offered. So what does the regulatory approval process look like under Section 5 of the bill itself? Permitted issuers, except state chartered ones, must go through a formal application and approval process before launching a stablecoin. Each federal regulator, the OCC, the FDIC, and the NCUA, depending upon the entity, is tasked with reviewing applications from entities in their jurisdiction. What are they looking for in these applications? The application must demonstrate, and the applicant must demonstrate that it can meet the requirements of Section 4, meaning reserve banking, meaning they got to have their backed one-to-one stables. Okay, that's critically important. Redemption policy, which means when customers want to redeem their stable coins, they're going to instantly get dollars back, no delays, no stall tactics, no nonsense, and other compliance. This is all critically important because in order to preserve the integrity of these stablecoins, they must be closely audited and they must be closely regulated to make sure they never depeg and they always maintain their reserve status. There's going to be a process for reviewing applications, and as those regulations get drafted, we'll start to get into the weeds of what all that looks like. But once a stable coin is issued, and there's going to be basically a 3-year window to get all this off the ground, okay? But everyone's going to have to fall in line and get their stable coins in regulatory compliance. There's also going to be an interest from foreign stablecoin issuers. The regulations are going to strictly control who can launch a foreign stablecoin because it must be comparable to the stringent requirements of the Genius Act. You may have seen that Tether announced that they are planning to enter the US market through the Genius Act with their own fully regulated, compliant Genius Act stablecoin. They're not US based, so they're going to have to comply with all these requirements and regulations before they can launch that stablecoin. And that's going to create a very interesting dynamic in the US because we have USDC, which is the front runner right now in America, even though there was no regulation in place that required the one-to-one auditing and so forth. They have been the most compliant stablecoin issuer in the US, and now they're going to have to get in line with the Genius Act, just like every other stablecoin issuer. But introducing Tether into the US market presents an interesting dynamic because now there's going to be a direct competitor to USDC for the US consumer market. USDT is recognized globally as being a massive stablecoin issuer. If they can penetrate the US market in a regulatory compliant way, that's only going to grow their bottom line. So I'm going to be curious to look at how this all unfolds. Now let's talk about the reserve banking and capital requirements for stablecoins under the Genius Act. Bottom line, 100% reserve backing. No funny business. To protect stablecoin holders, the Genius Act imposes stringent reserve requirements, meaning every permitted issuer must at all times hold reserves backing its outstanding stablecoins on at least a one-to-one basis in identifiable low-risk assets, generally dollar-backed, treasury-backed is where you're looking, okay? So treasury demand is going to go through the roof here. Cash and central bank balances, U.S. coins and currency, including Federal Reserve notes, bank deposits, funds held as demand deposits or other intermediary withdrawable deposits. These are the types that they can hold. Short-term U.S. Treasury obligations, T-bills, we talked about that. Overnight government repo and reverse repo. This is all just technical banking stuff, but this is all the sort of stuff that is comfortable under the Genius Act for backing these assets. Government money market funds, shares in registered money market funds that invest only in the above types of assets, meaning U.S. treasuries and cash equivalents. Other liquid government assets approved by regulators, and tokenized forms of all of the above. Critically important, no other asset class is permitted. Riskier instruments like commercial paper, corporate bonds, equities, or other cryptocurrencies cannot be used to back stablecoins. This is important, and this is why the Genius Act was passed. Because before the Genius Act, you could use treasuries to back stablecoins. You could use cryptocurrencies. You could use equities. You could use lots of stuff to meet your one-to-one reserve. The auditing process was not fully transparent because there was no law on the books that required the feds to go in and make sure all this was compliant. And there was no way of knowing what your full exposure was in these stablecoins to US treasuries. So this creates a hedge against that. The Act ensures stablecoins are as safe as holding dollars in a bank or in T-bills. This is critically important because this gives consumers that layer of protection that they need if they're going to comfortably send and receive stablecoins. If consumers know that it must be backed one-to-one to a USD equivalent or reserve, then they have little risk of a depeg scenario happening. There's a prohibition against rehypothecation. Another safeguard that's part of the Genius Act is it bans issuers from pledging or reusing or encumbering the reserve assets in any way except for certain limited purposes, which as we get the regulatory unfolding of all this, we'll get into. But in essence, what this does is it says that Treasury bills can be sold or used in repurchase agreements in 93-day increments or less, but reserves are to remain untouchable except for converting into cash for redeemers or routine safe investments. That means two big things cannot be done with these stablecoin reserves. They cannot be leveraged, which means they can't be pledged against other riskier things, and you cannot gamble with these reserve assets. So that protects against any funny business by banks, which could potentially introduce a depeg of the stablecoin and a contagion effect, which would impact consumers. Capital and liquidity buffers. In addition to holding 100% reserves, issuers may be subject to separate capital requirements, essentially a cushion of equity or retained earnings to absorb losses or operational expenses. These caps are there to prevent and to prepare consumers and protect consumers with sufficient safeguards. Now, they're going to be subject to examination and auditing, which means they're going to have a whole compliance regime. Again, I talked about the fact that I'm in cryptocurrency sector. I advise startups on regulatory compliance and legal compliance. And I can tell you from my experience that whenever you're dealing with Treasury, Office of Currency Comptroller, FinCEN, they are going to closely monitor, and you're going to have stringent record-keeping requirements and be able to comply. So that means any fintech, any bank, any issuer of stablecoins is going to have robust compliance measures in place in-house in the event of an audit or a review. There's going to have to be full transparency of disclosures and reporting. No funny business. Redemption policy requirements. A core promise of any stablecoin is that holders can redeem it for the underlying fiat currency on demand. Let me stop and pause here for why this is so amazing. We talked about the fractional reserve model that banks currently run, where they take in your deposits and they loan out your deposits, and they don't actually have your money in the bank if you ever come demanding it, because they operate on a fractional reserve model. And that's why we had to have FDIC insurance. FDIC insurance was created to protect the consumer against a bank run. The insurance of up to $250,000, you've seen the sign in every bank. Well, that was necessary because of the fractional reserve mess. Since stablecoins have to be backed one-to-one and have to be redeemable at any time the consumer wants their money out, you don't necessarily have to worry about those same fractional reserve risks when it comes to stablecoins, which is why for the life of me, I've never understood why all these anti-crypto legislators and anti-crypto I don't know what to call them. I'll just say these anti-crypto people, this war on crypto, why they've attacked stablecoins so aggressively when they're actually safer than dollar-backed deposits in banks, because there's no fractional reserve model going on here. Are you now starting to get why this is so huge for the consumer? Why this is such a tremendous game changer and why it's so disruptive to banks? So there have to be timely redemption procedures, and there has to be full disclosure. And this is important. There have to be monthly reserve reports. Transparency is further enforced by a requirement that each month, stablecoin issuers must publicly disclose the composition of their reserves. The audits, the independent certifications, and the constant requirement that they comply and that they show their books is going to give the consumer tremendous comfort in knowing that their assets are protected. Another tremendous benefit of this is protection against bankruptcy. If there's ever an insolvency with respect to a stablecoin issuer, the Genius Act provides that the first in line will be the consumer in redeeming their stablecoins. This is unlike most bankruptcies where, unfortunately, after the FTX mess and so forth, the consumer is always last in line as a creditor, and they don't get preferential treatment. They don't get priority in getting their money out under the Genius Act. All of this changes. So we've gone for a good bit now. I think I'm going to kind of wrap it up by just reminding you all why stablecoins under the Genius Act are a total game changer and present an amazing opportunity for consumers, businesses, family offices, and even banks that wake up to this to benefit from moving money at the speed of the internet on a blockchain, fully transparent, fully audited, pegged 1-to-1 to a US dollar treasury equivalent. This is going to be the greatest disruption to the banking model as we know it that we have seen in decades. And it's only just the beginning. This thing was signed a week from Friday, was signed into law. We now have to go through the implementation process where all the regulatory codes get written for how the application process is going to work, how it's going to be unfolded and introduced. And then you're going to start to see banks and other tech-forward fintech providers start to make applications to issue stablecoins in a regulatory compliant way. Once they've got that on board, now begins the work of educating the consumer, educating businesses, educating family offices on how to use stablecoins. Because if consumer doesn't understand blockchain technology, how digital assets move on blockchains, how to create a wallet, how to safely protect their digital asset wallet, how to protect their password and their seed phrase to that wallet, how to move money around using stablecoins, how to create agreements with customers, vendors, and other providers in order to now receive these stablecoins. You see, this is going to require a huge education campaign in order to get consumers on board to understand what all of this means. What does it mean? My bottom line is consumers are now empowered to move money at the speed of the internet as opposed to at the speed of banks. This breaks the fee monopoly banks have on moving your money around. This empowers consumers to do it on their own in a regulatory compliant way and have comfort to know that the assets they're moving are going to be backed 1-to-1, fully audited and secure. And it's going to onboard these consumers who have probably no exposure to crypto at all. It's going to be baby steps. They're going to be using crypto without even knowing they're using crypto. And once that happens, and once they get comfortable moving money at the speed of the internet via blockchain technology, they're inevitably going to be curious about what else they can do with cryptocurrency, which includes Bitcoin, Ethereum, Solana, XRP, and all these other interesting plays that can be made in the cryptocurrency sector. This is not financial advice. This is simply education. I'm simply providing a thesis that I think that stablecoins under the Genius Act will be the force multiplier for growing wallet adoption. You know, it was recently reported that cryptocurrency market cap exceeded $4 trillion. That's a pretty amazing milestone. And I don't know of any other asset class that has hit that level of market cap that has instantly disappeared. So I think it's fair to say that since every other aspect of our life is becoming more digital, that our money is going to become digital, that digital dollars are going to be the reality. Moving money on blockchains via cryptocurrencies is going to be the reality of how we transact. It's going to open the entire world up to commerce. This is major disruption for Western Union when it comes to moving money around the world. Major disruption for banks when it comes to their fee monopoly on moving money. And all of this is going to create more crypto native users of digital assets. And the more stable coins are integrated into this, the higher that market cap for crypto goes, 10 trillion, 25 trillion, 100 trillion, the more stable coins are going to be a part of that, which is going to grow the overall demand for US-backed, US-pegged stable coins, which is going to increase dollar dominance, increase demand for treasuries. And the best part, in closing, because I want you to have a Saturday. You came to class and you learned, but I want you to also have a Saturday and enjoy your weekend. But I want you to take away from this that this is going to now empower consumers, businesses, family offices to now improve their bottom line, to move money at the speed of the internet, to break the delays that come with moving money via banks. And all of this is going to cut down the costs of moving money for consumers. That's huge. I'm a big advocate of this, obviously. If you want to learn more about me, I gave a little bio at the beginning. I'm a lawyer. I've been practicing for almost 30 years, over 25 years. I don't remember how many years exactly at this point, but over 25 years I've been practicing law, mostly in criminal defense, but also with a focus on digital assets. And through my experience in the digital asset sector, I've had the opportunity to cover virtually every major legal development in crypto. And I've got a newsletter that I put out called the DeFi Defender on Substack. Again, if you go to my bio, you can see my link tree with all my links. I've got my podcast, Lexline, where I've interviewed hundreds of people in the crypto sector and unpacked how they built. And I also have my website, cryptocouncil.io, where you can go and learn more about me. My newsletter is also linked on my website. Again, none of this is attorney-client relationship or legal advice. This is strictly for educational purposes because in addition to being a lawyer for over 25 years, I'm also a former law professor. So I know how to break this stuff down and explain it. I love to teach. And this is very cool for me to be able to do this as a live broadcast because this is kind of like bringing this knowledge out to as many people as possible in the biggest way possible on these huge platforms, Twitter, X. I'll repurpose this for YouTube. Spread the word, educate consumers about what this can do to empower them and to break the current monopoly that banks have. All right, that's enough talk from Carlo. I hope everybody has a tremendous weekend. Don't forget to leave comments. Don't forget to follow. Don't forget to share this if you think it'll help somebody out there who could benefit from all this. And stay tuned for more. I want to know in the comments if you enjoyed this and if you want more of this. Definitely leave me a comment. And a follow would definitely help as well. Thanks, everyone. Now I got to figure out how to end this thing. So hold on one second. Okay, I'm ending it. Thanks for tuning in, everyone. Have a great weekend.